We're going to quickly review financing strategies for CCRCs with the primary focus on the advantages of bond financing. Typically, you're looking at two different options for large-scale senior housing projects: conventional bank loans versus tax-exempt bonds. The advantage of tax-exempt bonds are that you have a lower cost of capital over the life of the project. This is a chart that reflects why interest rates tend to be lower when they're tax exempt. Basically, it shows that it's because you don't pay taxes on the interest income. Conventional loans, bank loans, typically are shorter maturities than you'll find with bond-based financing, and there are lower lending limits, and it's tough to get the kind of capital necessary to build a large CCRC. Tax-exempt bond financing comes in different varieties. Unenhanced bonds means that they're not necessarily protected bonds. Basically, what happens is the issuer releases money to the trustee, who makes sure that both investors are paid and the borrower and construction group is paid. You can add insurance to the process, which will make the cost of capital less. But there is a cost for having an insurance policy. Basically, it guarantees that investors in the bonds will get paid. You also can set up a letter of credit. A letter of credit is usually representative of a bank or multiple banks, and the banks basically are taking on some of the risk and and backing up the financing process, again lowering the interest rate. So who's involved in the creation of a bond? You have your underwriter, who acts as the quarterback for the process, developing the plan of finance. The issuer, which is the government-backed entity that issues the bond. And then the trustee, who makes distributions of the money based on certain agreed upon criteria. All of these members are backed by attorneys. Counsel is a code word for attorney, and they are also part of the team. It represents a fairly intense legal transaction. As mentioned earlier, there are numerous choices and combinations of bonds involving different kinds of interest rate, credit quality, maturity, and how principal is amortized. These are the three primary types of interest rates: fixed rate, adjustable, and variable. Although in today's current recessionary environment, there is mostly only fixed rate financing available. There are advantages and disadvantages of each of these different types of rates. You can take a look at these. Basically, the cost of capital, how much it costs to borrow money. It costs more when bonds are non-rated, when nobody is backing them up and saying that the company that's borrowing is a good risk. So there are three primary ways to enhance a credit position in a bond issue. One is a letter of credit, which typically is offered by commercial lending banks. A second is credit agency rating, where an agency will look at an organization and give it a rating in term based upon their belief about the quality of the particular borrowing business. Third way to enhance credit is to take out bond insurance, and this is a way to guarantee principal and interest payments. This slide shows advantages and disadvantages of each of these three credit enhancements. The life of the bond, the longer the term, the more expensive, the higher the interest rate is. That being said, I think it's usual for terms to run about 30 years in large-scale projects. In order to be eligible for a bond, you have to have a government issuer and you have to have a borrower that is eligible that meets certain requirements. Typically, it's a nonprofit organization, and there are only certain kinds of costs that are eligible for bond-backed financing. These include basic construction, building, remodeling, and not very often is bond money available for any kind of operational expense. Finally, we have a brief glossary of terms. Take a look at these terms. These are terms that you'll see when encountering a bond issuance. And that's it.